From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, December 5th, 2025. Let's check the calendar. The Bucks without Giannis play the Philadelphia 76ers at Fiserv tonight and are off to Detroit for the Pistons on Saturday. Well, get well soon, Giannis. And this Sunday, the Packers play the Bears at Lambeau Field. Saturday morning, the Santa Claus Rampage sets off. 2,000 bicycle riders dressed as Santa Claus, Mrs. Claus, elves, and the reindeer roll through Milwaukee. Be careful out there. And the Milwaukee Streetcar, the Hop, celebrates the holidays for the next 3 Sundays with live music on board, and the best part, they've got free cookies. Let's start with politics, which can be messy business. At a rally in France, a 74-year-old smashed a raw egg on the head of one of the candidates. And later, the same candidate got flour-bound by a 17-year-old. The teen was caught and sentenced to take a course on citizenship. I thought a cooking course would be more appropriate. Also in France, thieves stole $200,000 worth of snails that were meant for gourmet diners at Michelin-starred restaurants. Even in a puff pastry with a parsley and cream sauce, I just can't eat that stuff. And finally, I'll leave you with the bizarre story of a break-in in Virginia at the ABC liquor store. When the staff showed up for work last Saturday, they found a trail of broken whiskey bottles leading to a culprit, a raccoon, who was found passed out face down in the bathroom door. Haven't we all been there? The little masked bandit was collected by the authorities, sobered up, and is now on his way to raccoon rehab. On the podcast today, we have Dave Sandstrom, Mike Hoelzl, John Sandstrom, and here with a wrap-up of the week is Joel Drisang.
Thanks, Max. I saw somewhere this week, and somebody can correct me, but that France goes through 97 million pounds of escargot in a year. Yeah.
Snails?
I can't imagine, yeah. And you're not eating any of them. So on the week, all of the major indexes improved. The tech-heavy NASDAQ went up 212 points this week, ending the week up 0.9%. For the year so far, it's up 22%. The S&P 500 gained a 0.3% this week. That was 21 points to end the week at 6870. That's up 16.8% so far this year. And the Dow Jones Industrial Average improved by 0.5% or 239 points. It is up 12.7% so far in 2025. Dave, why don't we start talking with you? That's pretty impressive. I mean, up double digits. And this isn't the first year. It's been like 3 years in a row now.
Joe, especially when you look back to what happened on Liberation Day on April 1st, markets, S&P 500 dropped 19% over a course of 2 days. Pretty remarkable recovery since then. And to your point, we pile that on top of the 2 prior years where we've seen substantial returns. It gets pretty easy for investors, and including professionals like us, to start looking over your shoulder a little bit, right. Kind of waiting for, okay, when is that next big correction coming? And I want to caution you to be careful not to make rash decisions or react to what maybe your gut feeling might be to allocating your portfolio. Instead, make sure that your cash needs and your short-term needs are covered. Make sure you have plenty of income in reserve and a bond portfolio to cover your retirement needs for the coming years. And that'll help you stomach anything the markets can throw at us. And really, when you look at the economy, kind of peel back all of the hype and the political unrest and the global issues we're having, and look at Main Street America, we see a very strong economy, employment very low, wages still growing at a very reasonable rate.
Faster than inflation.
We're seeing record spending on Christmas this year, on both Black Friday and Cyber Monday. And then you kind of look forward into the crystal ball and you see the massive amounts of commitments to artificial intelligence spending on the horizon. Data centers across the country. the employment picture looks pretty darn good, and that historically has meant the economy continues to roll and earnings are strong.
Yeah, I'm seeing mixed news reported. We had 2 reports this week because we still don't have all of the data that we rely on from the government for things like unemployment and job losses. But we had a report this week from ADP, a payroll service, showing that there were layoffs in November. It was the 3rd time in 4 months that's happened. We also had a report from the outplacement firm Challenger, Gray and Christmas, and they said that November layoff notices from employers was the biggest it's been in years. And still we have some of the numbers that we are getting from the government, the unemployment insurance claims, and the moving average on that was the lowest it's been since January, and it's 41% below the all-time average. So we're seeing some concerns along those lines, but we're also seeing that people are spending money. We got a report today about consumer spending, and that was up in September. It was a delayed report, but it's showing people are still out there spending money. And Mike, we were talking about this a little bit beforehand, but we're also seeing more anecdotal evidence or hearing more reports about people cutting back on things that they wouldn't normally cut back on just because they feel more worried about their money.
Yeah, because everything needs a moniker today. The moniker out there is, and I'm not making this up, stealth austerity. I mean, I don't know if someone gets paid for making that up, but if they do, come my way, I'll take a check. Yeah, you're seeing things where people are canceling subscriptions and, streaming subscriptions and, cutting corner on maybe not going out to dinner as much. It is interesting, to Dave's point about the amount of spending, that is happening, which is kind of almost creating this, kind of floor if the market were to fall. But there's an interesting study out there. I can talk on a Friday afternoon, everybody. That 50% of the spending in this country is now done by the top 10% wealthiest families. And they define wealthiest families by, I believe they set the bar at $250,000 and up. So those people are still spending a lot, which is good. But then you get and I'll say it again, stealth austerity, just to let that sink in for everyone. A lot of people below that are starting to cut back on certain things, right? Like they're stretching out their car another year or two because, car prices are a little higher right now. Then maybe they're not going out to dinner as much. I brought it up the last time I was on the podcast, how Hamburger Helper is having one of its best years in a very long time. And that's just another, again, I will say it again. I am not saying that Hamburger Helper is a bellwether of the U.S. economy. Please do not take that away from me. But what I am saying is there's a lot of people now that are starting to stretch their dollars a little bit more because for whatever reason, right, maybe their wages didn't go up or maybe they had someone that lost a job because, as you mentioned, Joel, there is kind of a mixed bag out there with job numbers. So while the spending is still pretty good, it's coming a little bit more from just a smaller group than the broader group, which can cause some stability and yet a little bit of fragility, if I can be that way. Because if there's any shift in spending in that smaller group, that could turn kind of markets or economy in a downward fashion. But as of right now, there's really no indication that is going to happen.
Right, and that's helping, as we said, the markets. The markets are still growing. John, what are the consequences of this market growth these last 3 years, this year included, is capital gains? And what should investors know about that?
Yeah, so I actually had a couple of conversations with clients this year asking specifically about capital gains distributions because the past couple of years we've seen some pretty big numbers. So just to clarify everything, we invest in mutual funds a lot of the time, and those are actively managed, where the people who are managing these funds for us, they are constantly trading, selling, buying, and that generates capital gains. You buy something low, you sell it at an appreciated price, that generates a gain. They're legally required to pass those gains on to the owners of the fund, the investors, which is us, which is clients. They have to pass 98% of all of those gains through. And you take that gain as an owner whenever they pass it, and that counts as your capital gain for the year.
So you didn't decide to do that. That was done for you.
It was all John.
Yeah, it was all my fault. But there's a couple ways to be strategic about this, right? So you could take those capital gains in as cash and use that opportunity to rebalance your portfolio. That's something that we've done for clients if it makes sense. It's a very easy way to rebalance, especially on some of those highly appreciated stock funds that are passing 7, 8, 9% gains this year. This is only in effect for taxable accounts, not necessarily your retirement account. So it's good to keep that in mind as well.
Because there are tax consequences for this. Exactly. Yeah. So investors should be expecting that happening in their portfolios and make plans for it?
Absolutely.
Okay.
Yeah.
Dave, we're also looking next week. There's anticipation of the Federal Open Market Committee from the Federal Reserve Board. They make the policies on interest rates. We're expecting them to cut rates again, although we've seen from past few weeks that there's more discussion of, maybe they need to be concerned about it. What sorts of things, when they do that, are you going to be looking for in terms of what they do and maybe sometimes more importantly, what they say?
Yeah, I think sometimes, Joel, it's really more about the forward guidance than it is about their activity at that point in time, because quite honestly, in most cases, the market has already priced in what they announce because they consistently give that forward guidance. So I think the market's expecting another quarter point. So it'll be interesting to see what they say about what might be on the horizon. It appears as if they may be slowing in their desire to continue to cut rates. So I would anticipate a rate cut on the next meeting and then a potential pause for a while, unless we see significant weakness in the economy where they would be forced to go further. But they're walking a little bit of a tightrope because you still see the spending going on. You see significant economic activity. Inflation, while it came down a little bit to 2.8 from the prior month at 3, is still a little higher than their target. They're trying to get things to 2. So they're kind of in a little bit of a tough spot with that. So I think they're going to continue to proceed with caution.
And we're still looking at lots of tax refunds that were built into the tax laws that passed in July. Some of them are extensions from the 2017 changes. There's still talk of Trump accounts, which I guess that wouldn't be money that's spent right away, but there's still talk of tariff refunds. So all those sorts of things would keep fueling spending, which is good for the economy, but too much spending fans inflation, and that's when the Fed is in a dangerous spot of cutting rates and might be more apt either not to cut them or to raise them.
Real quick, I'm kind of fascinated with where the Fed's going forward guidance-wise, because with Powell's tenure being up here early in 2026 and Trump appointing someone, I guess the leader in the clubhouse right now for all you betting people out there is Kevin Hassett. Don't take my word for it, things can change. But it's going to be a significant shift, right, where he has basically said whoever the president puts in is going to be mandating steeper cuts. Now, that person can't do it alone, right? But I think it's going to be different where Powell is very data-driven. Not to say this other person, whoever it won't be data-driven, but if he's going in with a mandate to cut rates, I wonder how much that forward guidance maybe changes. So I think Powell's up in February. Correct me if I'm wrong. I'm fascinated to see what they say now and then how that changes possibly 2 months from now when someone new comes in.
Right. We haven't talked about bonds yet. This week, the U.S. Treasury, the 10-year, the benchmark Treasury, gained a yield of 0.12 percentage points. It's now at 4.14%. It started the year at 4.57%. So it's that's some change, and I'm wondering what, if anything, that means to investors, and what, if anything, they should be doing about that or watching for their portfolios.
Well, Joel, obviously, you've heard it many, many times on this program that it's all about earnings and interest rates, and we've obviously come in the last decade through a significant change in the bond market. the Federal Reserve, after the financial crisis, took the overnight rate to zero, and it ended up producing a scenario in which bonds, you want to call it the lost decade for bonds, that was it. So it was nice to see this year be very lucrative for bondholders, finally restore some confidence for investors in their bond portfolios. But I think we're kind of settling in now. I think the 10-year Treasury long-term averages in that mid 4% range. We've had fund managers in the office that have lots of experience in the bond market, suggesting that we're going to be range bound a little bit here going forward in that 4%, 4.5% range. So we may see the potential for yields to come back up a little bit. Wouldn't surprise me a whole lot because we've had such a windfall this year. But stabilizing maybe in that 4 to 5% range.
But to your point, Dave, like with the bonds being like range bound, I know some clients we talk bonds are boring, and yeah, that's the point. So if they are range bound and you're just kind of in this nice little range where you know what you're going to get roughly, and you can bank on that, that's a good thing. I've had some clients kind of push back on that because they like the action of stocks a little bit more, but the whole point of bonds is to be boring. And so if they're going to be boring and pay you some money out of it, great, all the better.
And you've got that boring part for the part for that part of your portfolio because there's volatility that gets a little more stressful in the other part, right?
Correct. Yeah, absolutely.
Finally, one last thing here. I wanted to talk a little bit about gifting rules because it's that time of the year when families are thinking of giving money away and stuff.
Make your checks out to Mike Hoelzl, Hoelzl.
Are there any other Mike Hoelzls?
Oh, God, I hope not. One in this world is enough.
But I'm just wondering if there are certain things that folks should know, if you're hearing any questions from clients about those sorts of matters and what they should be doing.
Well, Joe, I think gifting is a fantastic way to start to share some of the wealth with your family prior to letting it pass through your estate in some cases. Obviously you need to make sure that your expenses and your retirement needs are covered, of course, but I do think there's some benefits that could potentially come along from being able to share some of that money with the family. And currently the annual gifting limit is $19,000 per person. And I think there's a lot of confusion about that number because you can go beyond that and it isn't immediately taxable. I think there's this misnomer out there that people think if I exceed that $19,000 number, I'm suddenly going to be burdened with some kind of tax liability. And that's not the case. You'll have to report the overage on your tax return, and it does impact your lifetime exemption, which is currently $13 million plus, which a lot of people will not be impacted by.
God bless you if you run into that problem.
But so my point is, if you're trying to help a family member out, a child, maybe with the down payment on a house, something that might be larger than that $19,000, talk to your tax preparer and get a really good opinion on that, because it may not be as tax egregious as you might think.
And is it $19,000 per person? So if I wanted to give my kid $19,000, but they had a partner, I could give that person $19,000 too, and my wife could do the same thing. So all of a sudden it's $76,000.
Yeah. So yes, you can get to a pretty big number by spreading it across the family members, and you don't have to do anything. You don't have to file any tax forms or anything.
And here, real quick, because I had this exact conversation with clients this week. And one of the things they talked about was, why should I wait for my kids to get this money when I'm dead, when I could give some to them now and watch them enjoy it? And that's really kind of where I'm coming from with this. Like, everything Dave said is correct with the talk to your tax preparer, because that is key. But also, if you think you're not going to spend all your money, watch your kids or your grandkids enjoy it. I guarantee you, every client I've had that has done it has not regretted it one bit.
Great. Thanks, Mike. Dave, John, Max, and Jason over there on the controls. We haven't heard his voice, but he's here in the room. And thanks to everybody for listening. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.